So I just bought more of this stock, and for reference, this is my portfolio. So if you haven't guessed that stock yet, it is a company that is quite a monopoly. It is none other than ASML. So ASML year to date is up around 7% after this drop. It is currently trading at around a 26 times earnings, adjusted for their earnings that they just reported this quarter. So for TSMC, the company just reported earnings today, and the company's earnings were quite amazing. TSMC's profit increased by around 61% to record high, fueled by AI chip demand. So I expect ASML to be able to ride on this trend as well. When TSMC increases their earnings, you can expect ASML to increase their earnings as well. After all, TSMC is a customer of ASML. So for the company, this is my valuation. So I have the bear case, I have the base case, and the bull case. The base case is what the management is currently projecting this year. So they're projecting around 15% increase in net sales from 2024 last year. So currently that will put it at around $32.5 billion. And so my base case scenario, my fair value for the company is currently now at around $850. So I think at $750 today, the company is presenting a decent buying opportunity. And that's why I added a bit to my position, although I have quite a sizable amount in that stock already. The next portion that I'll be talking about is Berkshire Hathaway stock. So the stock has been down by quite a fair bit. It's down around 12% since its all-time highs in early of April. So the stock right now is underperforming the S&P 500, and ever since Warren Buffett left the company, the stock is down around 12%. So for Berkshire, the valuation is not very good yet. So the price to book currently is at around 1.5 times. In the recent years, this is on the high side, and the price to operating income for the company is also at around 21 times. So the company is not cheap by any means. If you price it based on the price to operating income at a 21 times price to operating income, with the operating income barely even growing, I think the company is still trading on an expensive side. So for Berkshire, while I agree with their increase in the cash pile, I think there's no better capital allocator than Warren Buffett. And since Warren Buffett has stepped down already, I'm not too sure how the new administration will be able to deploy such amounts of cash. So they currently have around $350 billion worth of cash sitting in a balance sheet. And so I'm not too sure how Greg Abel is going to handle this. If we ever see a stock market correction or stock market crash, I'm not too sure how he's going to deploy it. And that is why I think Berkshire Hathaway is less predictable than it was when Warren Buffett was in charge. So for Berkshire, it is probably a bit too big for more growth. The company is basically victims of their own size. The company will retain its legendary status, but no one will be able to deploy capital better than Buffett himself. So while Greg Abel will be able to adopt a Warren Buffett style approach when it comes to investing, I don't think he'll be able to outperform the market like what Warren Buffett did over the past few years. The company isn't cheap, so I wouldn't say it's a great buy right now. It is probably around fair value or so. I think a reasonable price for you to buy Berkshire is at around 1.4 times price to book. That was when the company was still buying back their shares. Currently, they've stopped their buybacks because they think the company is trading on an expensive side. Next portion that I'll be talking about is your healthcare companies. So Elevance today is down around 11% after reporting their earnings. So this was Elevance earnings. Elevance Health Q2 2025 EPS misses forecast. The stock drops. They also said that they will be revising their adjusted EPS guidance to around $30. So it's down from that $34 that they forecasted in Q1 of this year. That represents around an 11% drop, which is proportional to how the stock reacted today. So for Elevance Health, they have significant portions of their revenues coming in from the Medicaid portion, and the Big Beautiful Bill supported a lot of Medicaid cuts, and so that was what the company cited as a reason for this decrease in the guidance of their EPS. So a lot of your healthcare companies are crashing. So for example, another company which is Canteen is also down around 55% from a year ago. Elevance Health is down around 32% from a year ago. So all these companies, all your healthcare insurance companies, they're tanking by quite a fair bit because of your bill as well as cost pressures. So this is an industry-wide thing that all companies in this sector are facing. I think for healthcare insurance stocks, that typically avoids because the industry is extremely complex. It is very hard for you to understand what is going on in the industry. And it is also heavily regulated as well. So for United Health, the stock reacted by dropping around 1.4%. The company is now trading at a 12 times earnings and the dividend yield is around 3%. So United Health didn't react as badly as all the other companies because it has limited Medicaid exposure. The company only has around 7% of their revenues coming in from the Medicaid sector. So for United Health, we have to see how the company performs on July the 29th. I expect them to issue massively lower guidance. But how low that guidance be could be an indicating factor of where the stock will move over the next few months. So for United Health, it is one of my weaker positions in my portfolio. It's a fundamentally strong company that is facing constant noise and internal problems as well. I'll hold this name, but healthcare insurance as a whole is a weak industry to invest in. For United Health, I'm not expecting too much upside in terms of the stock price. This stock will likely be a long-term turnaround play from here on out. So I'll be holding on to this name probably over the next few years. Next portion that I'll be talking about is Copart. So Copart is a company that I'm deeply interested in right now because the company is at its 52-week low. So for Copart, the stock is down around 18% year to date. And as you can see, the stock is at its 52-week low. The stock is currently trading at a 30 times earnings. So for Copart and their competitor, which is IAA, this is their business model. So basically when an accident occurs here, the vehicle is moved to the yard, and then your vehicle arrives at the auction yard and is stored there. And then they go through a sale. So they sell their vehicles online on their platform. And then once that happens, the vehicle is sold on their platform and they collect a fee as well as all the charges required to move the car to the yard, and from the yard to the shipment place. So for Copart, this is basically their business model. They sell salvage cars similar to what IAA does. So for Copart as well as IAA, they have secular growth trends basically pushing ahead for the stock. So for Copart, 80% of their volumes actually come from insurance companies. So for insurance companies, what they will tend to do is they will assess whether or not the repair cost is greater than the value of the car. And if the repair cost is greater than the value of the car, then the car will be deemed as a total loss and it will be sent to either Copart or IAA for sale. So for Copart, when you have a growing aging car base, that leads to a higher frequency of your total loss because as the vehicle becomes older, the likelihood of salvage increases. The other tailwind for this company is basically just the repair cost. So a lot of your cars, they're becoming more and more complex. You're having EV batteries, you're having batteries that are being swapped here and there, and those are adding up to cost, which leads to a higher frequency of total loss as well. And the last one is simply just your total loss ratio increasing, because for humans with the perception of your cars being more safe, they themselves are becoming more and more reckless, and that is in turn leading to more accidents, which is leading to a higher total loss ratio as well. So these are some secular tailwinds for the company, and besides that, your Copart's car demand will never fade away because you have all your rebuild repair companies, and you will also have demand outside of the US for all these US cars because your US cars, they have their own brands and their brands are normally much highly priced in their own countries. So around 34% of their vehicle sales actually goes to countries outside of the US, and that is a sector that is growing strongly for Copart. So for Copart, there's also a price floor for the company. So the company now has around $4 billion worth of cash. That is around 10% of their total market cap. And they also have significant amounts of land. So the book value for the land is around $2 billion. So if you were to account that to around market value, that would be around $4 billion as well. So around 20% of their market cap is actually made up by physical assets and cash. So that is a price floor for the stock. And if you were to account for the cash that the company currently has, the company is actually trading at a 27 times earnings. So for Copart, the valuation is quite sound as well today. The company is trading at 30 times earnings, and over the past few years, that is around the average for this company. So the company now is trading at a fair valuation, and that is why I think the company is getting a little bit interesting. The company is a high quality one, and the valuation is normalizing to a point where it is reasonable. It always interests me when companies get to 52-week lows. The last portion, I'll be talking about some questions left in the comment section. So the first one, it says, what do you think on Brookfield stock, BN? Many out there saying that it is the easiest 15% CAGR. So when you see things like easiest 15% CAGR, I mean that's a red flag already. But for Brookfield, based on my understanding, it is an asset manager. Basically what they do is they will acquire assets. And for Brookfield, the problem with the business is they have low quality earnings. So they're leveraged to the brim. And when a credit event happens, if a credit event happens, then you will see companies like Brookfield being sucked out of it because they are highly leveraged. And for me, I don't like too much leverage in my companies. I think for companies like Brookfield, like a lot of your banks, although the stock price has risen by quite a fair bit over the past few years, a lot of their earnings are low quality because they're highly levered. And for me, asset managers, they are highly unpredictable businesses I would avoid. Next question is, would you consider doing an Airbnb analysis similar to Copart review? So for Airbnb, I view it as a company that is high quality. It is a company with a moat and a network effect. But for Airbnb, the problem is it has always traded at a premium valuation. So the company is trading at a 34 times earnings now, at around a 28 times real price to free cash flow. So the company is currently growing at around 10% or so. And if you have to add in their buybacks, the company will grow at around 12%. So for a 12% growth company facing regulation risk, I think it is an expensive price to pay. For Airbnb as well as travel, they are highly susceptible to economic downturns. So for now, I'll be staying out of this company. I think Booking has better metrics fundamentally, although I think Airbnb has the strongest business model. I hope you guys have found this one useful and invest safe.